Today, stars align to create a bubble dream, but is a nightmare around the corner? Hi again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news. Well, this is our weekly market update where we review the market action starting in the US, then Europe, Asia, and Australia, and also cover commodities and crypto along the way. This is a data-packed segment, so be warned. This week, markets drove higher pretty much across the board, thanks to the fallout from the Federal Reserve slashing interest rates last week, and more benign US economic data, and China finally moving more determinedly to bolster growth as the central bank lowered interest rates and injected liquidity into the banking system, and with more fiscal measures expected to be announced before a week-long Chinese holiday starting on October the 1st. Listed shares of Chinese companies jumped on the latest series of stimulus measures from Beijing to boost the domestic economy, including those on international markets. As a result, we saw upswings in markets across the globe, and this despite weak oil prices and rising conflict in the Middle East. The MSCI gauge of stocks across the globe rose 0.25% to an intraday record high, and Europe's benchmark stock 600 index closed at a record high, ending up 0.5% to 528.08. China's blue chips jumped 4.5%, bringing their weekly rise to 15.7%. That's the most since November 2008. And Hong Kong's Hang Seng Index also gained 3.6% and was up 13% for the week. That's the best performance since 1998. The Dow Jones Industrial Average rose 0.33% to 42,313. The S&P 500 fell 0.13% to 5,738, and the Nasdaq Composite fell 0.39% to 18,199. All three major US stock indices posted a third straight week of gains, though Nvidia's 2.2% decline was the reason for the S&P 500 and Nasdaq slipping on Friday, pointing to a report that China is urging local companies to stay away from its chips. But the Nasdaq Golden Dragon shot to 7,236, while the Russell 2000 was at 220.33. The best performer of the session on the Dow was Chevron, which rose 2.47%, while the worst performer of the session was Amazon, which fell 1.67%, and IBM, which was down 1.66% to 220.84. It's a bubble dream, according to the Bank of America equity strategist Michael Harnett. His data had another $10.9 billion US dollars flowing into US equities in the week ended 25th of September. Fed cutting into recession is negative for risk assets, but Fed cutting with no recession is positive, and investors are firmly of the view that the Fed and China is sufficiently policy easing to short-circuit recession risk, Harnett wrote. On Friday, US Treasuries and the dollar both fell as a subdued US inflation report lifted expectations of an outsized interest rate cut at the Fed Reserve's November policy meeting. The yield on benchmark 10-year notes was last at 3.756 from 3.789 late on Thursday, while the 2-year was at 3.557, down 0.16%. The Personal Consumption Expenditures Price Index, that's the Fed's favored inflation measure, rose 0.1% in August after an unrevised 0.2% gain in July. Economists had forecast PC inflation rising 0.1% too. In the 12 months through August, the PCI price index increased 2.2% after rising 2.5% in July. When stripping out volatile items like food and fuel, the so-called core PCE price index also decelerated to a 0.1% month-on-month move, but sped up slightly to 2.7% from 2.6% on an annualized basis. Elsewhere, the National Association of Realtors said on Thursday its pending home sales index based on signed contracts rose 0.6% last month to 70.6 from July's 70.2, which was the lowest reading since the series started back in 2001. That decline had tracked a drop over the month of August in the yield on the 10-year Treasury note, used as a benchmark for mortgage rates in anticipation of a Fed rate cut at its September meeting. The Fed did cut last week, of course, as anticipated, though by a larger than expected 50 basis points, with more cuts seen in the months ahead, and mortgage rates this month have fallen closer to 6%. Still, sales activity is likely to remain subdued, even with the decline in borrowing costs. Ongoing home price gains continue to offset a portion of those savings, and inventory remains limited as well. Markets are fully priced in for a cut of at least 25 basis points at the Fed's November meeting, with expectations of another upsized 50 basis point cut now at 56.7% after the data. That's up from 49.9% before the release. Other data showed US consumer spending increased slightly, less than expected in August, and household income growth was also unexpectedly lower at 0.2% from 0.3% in July. The figure was tipped to edge up to 0.4%. Ongoing conflict in the Middle East, with Israel's attack in Lebanon, also pushed Treasury prices higher in a flight to quality bid, pressurizing their yields. The dollar index, which measures the greenback against a basket of currencies, including the yen and the euro, was down 0.1% at 100.43, while the volatility index, the VIX, rose 10.34% to 16.96. Aluminium prices in London touched a 16-week high on Fed buying triggered by the latest economic stimulus measures in top metal consumer China. 3-month aluminium on the London Metal Exchange was 0.4% higher at 2,637 per metric tonne in official open outcry trading after hitting 2,659. That's the highest since June the 6th. Iron ore was also stronger, up to 92.98 in US futures. Oil prices rose on Friday, but fell for the week as investors weighed expectations of higher global supply against fresh stimulus from China. US crude rose 51 cents to settle at $68.18 a barrel, and Brent edged up 38 cents to $71.54 per barrel. Oil dropped on a media report that Saudi Arabia plans to dump its unofficial crude price target of $100 a barrel. Silver rose to its highest level in nearly 12 years, with interest rate cuts by major central banks lifting investment interest in the precious metals, but ended down 1.28% to $31.95. Gold futures was at 2,668, holding just below its record peak, thanks to central bank buying and its status as a safe haven asset in times of trouble. Again, it's worth noting that stocks are priced for perfection plus, yet there are potential hurdles for further stock progress. From the start of the US third quarter US earnings season, the US election, tensions in the Middle East, and the trajectory of interest rates, it seems that retail investors have broadened their purchases outside of tech since the dip at the start of September, suggesting sentiment remains generally optimistic. And while September traditionally is one of the weakest months of the year for markets, it's defied expectations this year, but expect more volatility ahead. And October has been known for volatility, often marked by sharp declines and even crashes, particularly in election years. Historical data indicates that October ranks as the worst month for election year performance across the Dow, the S&P 500 and the Nasdaq. On a technical level also, the Dow and the S&P 500 have broken out to new all-time highs, but the Nasdaq has not yet followed suit, and small-cap stocks remain weak. Market breadth indicators suggest that while many stocks are moving higher, the gains are not evenly distributed, with technology stocks leading the charge. And Wall Street's benchmark S&P 500 is up 20% year-to-date, near a record high. With the third quarter ending on Monday, the index is on track for its strongest January to September performance since 1997. Over in Europe, stock markets also touched a fresh record high in mid-morning deal-making on Friday, fueled by momentum from the Chinese-led rally in Asia. The measures bolstered luxury stocks in Europe, which derive much of their revenues from sales in China. Shares of high-end fashion groups like LVMH, Kering, Hermes, and Burberry all advanced, while automotive stocks gained as well. The DAX index in Germany traded 1.22% higher, touching a new high on the way. The CAC 40 in France rose 0.64%, and the FTSE in London climbed 0.43%. Inflation in France and Spain both dropped by more than anticipated in September, adding to expectations that the European Central Bank will roll out another interest rate reduction next month. In France, annual consumer price growth eased 1.2% from 1.8% in August. That's below economists' forecasts of 1.6%. And a corresponding figure in Spain also cooled to 1.5% from 2.3%, slower than projections of 1.9%. Germany, the largest economy in Europe, has recently seen sluggish economic performance, raising concerns that a looming recession could have consequences for its equity market. The country's reliance on exports, particularly in industries such as manufacturing and automotive, have left it vulnerable to global economic uncertainties. Capital economic analysts mentioned that the DAX 40 is already showing signs of vulnerability as investors respond to economic forecasts. Eurozone inflation numbers due out on Tuesday will be under close scrutiny as the ECB decides whether to cut rates again in October. Economists reckon the overall Eurozone print fell below the ECB's 2% target for the first time since June 2021, thanks to low energy prices, though it's expected to rise again in the final months of the year. Investors now see a 50% chance of a 25 basis point October rate cut they thought was unlikely just last week, as Eurozone business activity unexpectedly contracted in September, soaking fears the ECB is behind the curve. The best performer in the session on the DAX was Brenntag, which rose 6.94%, and the worst performers of the session were Heidelberg Materials, which fell 1.64%, and Siemens Energy, which declined 1.35%. The DAX Volatility Index, which measures the implied volatility of the DAX options, was at 1.5% to 1517. In the race towards neutral rates, the Bank of England is trailing well behind the likes of the Federal Reserve and the European Central Bank. Markets show that traders believe the Bank of England is almost certainly going to cut rates far more slowly than most other major central banks. Upcoming data on second quarter GDP growth is unlikely to sway the hand of policymakers in London, who are still concerned about pockets of persistent inflation in the economy. The new Labour government has sounded the alarm about the dire state of Britain's finances, something October's budget will seek to address, and consumers are at their most miserable in 6 months as a result. Figures during the coming week on mortgage lending and consumer credit might provide some much-needed cheer, or maybe not. Asian markets had a rocket under them thanks to that news from China. An official readout from a meeting of China's Politburo said that Beijing would deploy necessary fiscal spending to meet this year's economic growth target of roughly 5%, acknowledging new problems and raising market expectations for fresh stimulus on top of measures announced in the week. China's central bank slashed interest rates and fed more liquidity into the domestic banking system on Friday. A spate of measures announced this week by Chinese authorities include debt issuance of 2 trillion yuan, another 1 trillion yuan to be injected into state banks, all aimed at boosting lending and consumer spending. In addition, Reuters said the cities of Shanghai and Shenzhen are planning to remove key home purchase restrictions in the coming weeks. China's officials are also eyeing a special sovereign bond issue worth about 2 trillion yuan, according to Reuters. Under the planned changes, potential buyers will no longer have to be vetted for eligibility, and people from other places in China will be allowed to buy homes in the popular cities, which have previously had tight controls due to worries about excess speculation. The moves, if implemented, would mark the latest efforts by Chinese policymakers to arrest the prolonged downturn in the struggling real estate sector, which has weighed heavily on growth in the world's second largest economy. Prices for new homes in China fell by their fastest rate in over 9 years in August, according to official data, indicating that previous measures had failed to put a floor under the market, let alone spur a meaningful recovery. The measures, which would come after a separate stimulus package that was announced during the week, are expected to be announced prior to the week-long holiday set to begin on October the 1st. If the reports are correct, the package may well help lift China's gross domestic product by around 0.4% over the course of the next year, according to Capital Economics. Hopes for the increased stimulus powered stocks in China to the best week since 2008. The CSI 300 was up 4.47% on the day and 15.7% across the week, while the Shanghai Composite was up 2.89% on Friday and 12.81% for the week. Factory activity data in China is due out on Monday across both the official and private sector surveys. Given the wave of optimism that swept across global markets in the wake of Beijing's announcements, investors may for once look past Monday's likely dismal numbers. And we'll also get China's Purchasing Manager Index data as well. Hong Kong's Hang Seng Index added 1.5% and benefited from gains in heavyweight tech stocks. While it was a good week for just about every market, whose fortunes are tied to China, with an index of mainland Chinese property stocks up 20% for the week and iron ore prices higher, it does remain to be seen if the rally will last. After all, China's A share market has repeatedly disappointed investors, with the benchmark CSI 300 no higher than it was in 2007, while the S&P 500 was up 300% or so. Japan stocks were higher on Friday as well. At the close in Tokyo, the Nikkei 225 gained 2.57% to hit a new one-month high. The Topix had a similar trend. The best performer of the session on the Nikkei was Lasertech Corp, which rose 8.19%, while the worst performer of the session was Sumitomo Mitsui Financial. And that fell to 3-year lows, falling 3.3%, while shares in SoftBank fell, losing 3.24% to 191.30. And the Nikkei Volatility Index, which measures the implied volatility of the Nikkei 225 options, was up 5% to 2601. The yen firmed against the dollar after Japan's former defense minister Shigeru Ishiba looked set to become the next prime minister. Markets had been largely expecting a win for a hardline nationalist who was an opponent of further interest rate hikes, so were pricing in loose monetary policy and fiscal policies and a weaker yen over the past week. Against the Japanese yen, the dollar weakened 1.82% to 142.19. And India's Nifty 50 came off record highs to end down 0.14% to 26,178. Australia's shares scaled a fresh all-time closing high on Friday as a strong rally in miners offset losses across much of the index, including a cratering share price drop for the embattled casino operator Star Entertainment. The ASX 200 closed up 8.5 points or 0.1% to 8,212. On the week, the index ended flat, following 2 weeks of gains. The advance was heavily concentrated in materials, as China's stimulus pledges this month bolstered optimism for iron ore, copper, and lithium. Shares in Rio Tinto rallied 3.4% to 127.45, and BHP climbed to a 4-month high of $44.86 and closed 3.1% higher at $44.74. Fortescue advanced 3.6% to $20.10. And the push higher came after iron ore prices jumped more than 4% in Asia to trade above $100 US per tonne. Lithium miners also went higher, led by a 40% leap in mineral resources to $49.14. Sayona jumped more than 6.9% to 3.2 cents, and Liontown Resources powered up 8.3% to 78.5 cents as speculators were forced to cover their short bets on the sector. There's such a huge short interest across the sector that those positions would be nervous. That's probably why there's a decent wave of buying happening at the moment, said Sam Berridge, portfolio manager at Perennial's Natural Resource Trust. The implications is that demand for electric vehicles will pick up, he said. On the ASX, of the 11 sectors, 8 were flashing red actually, with health leading the losses, and the big 4 banks fell as the stock rotation out of financials to miners continued. National Australia Bank dropped 1.8% to $36.94, and CBA fell to $134.16. Macquarie was at $233.49. Casino Group Star Entertainment was by far the biggest casualty in the index, clocking a 44.4% plunge to 25 cents. Shares had been halted for 4 weeks in the lead up to Friday's sell-off as the company scrambled to shore up its financial position before releasing its financials. Woolworths and Coles were down most of the day after the competition watchdog ramped up pressure on the supermarket giants. Coles slipped 0.5% to $18.06, but Woolies managed to bounce back late in the session to end 0.2% higher at $33.43. Hospitality and beverages company Endeavour Group was among the biggest losers on the ASX, down 2.5% to $4.99 on news that the chief executive was leaving. And funds management company GQG Partners dropped 2.4% to $2.81 after copping a $725,000 penalty from the US regulator for violating whistleblower protection rules. And De Grey Mining lifted 3.4% to 1.385 as it denied a media report suggesting the gold miner had received a bid offer from Canada's Agnico Eagle. The Aussie was higher at 69.02 US cents, reflecting the higher interest rate outlook in Australia, and 51.61 UK pence. In crypto, the Bitcoin price hit a 2-month high early on Friday, around 67,000 US, but it was last at 65,709. The original cryptocurrency is back to levels not seen since July, boosted by a stock market rally fueled by upbeat US labor market data and economic stimulus moves from China. Elsewhere, Ethereum jumped 0.85% and was last at 2,673.10. Bitcoin's rally started last week after the US Federal Reserve made its first interest rate cut since the COVID pandemic, and China's moves helped as well. As Bitcoin's price climbed, US spot exchange-traded funds saw a daily net inflow of around $365 million on Thursday. So, in the context of overvalued stocks, markets are still betting on higher ahead, which is still quite possible, but below the surface, there are significant cross currents and risks, so volatility will remain the watchword, and the bubble dream might yet turn into a nightmare. We will see. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.